Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. In the wake of the Fed meeting, financial markets have concluded the Fed will not only ease in July, but also cut rates aggressively before the end of this year. I think potentially the markets have gotten out ahead of the Fed, and I think it's worthwhile for us to kind of review and understand that there is a decent chance the Fed won't move in July. In the June 11th podcast, a rate cut in the June meeting is not likely. I explained why I thought the Fed would not act in June. And the primary reasons is that the employment and labor market is in good shape, and inflation really isn't that far under the Fed's target. So that were the primary reasons why I thought the Fed would not move in June. Every quarter, the Fed updates its projections for GDP growth, inflation, and where they think the Fed funds rate is going to be over the next couple years. It's interesting to see what the Fed estimated. It shows that in March, the Fed expected GDP to be 2.1% for all of 2019 and to slow a bit to 1.9 in 2020. What's interesting, at the June meeting, the Fed basically left GDP projection unchanged at 2.1 and only thought GDP would slow to 2.0 in 2020. So the Fed doesn't really expect an awful lot of additional slowing from here. The PCE core inflation, in March they thought it would be 2% both in 2019 and 2020. Now they expect 1.8% in 2019, but they expect it to tick up a little bit to 1.9. So although inflation is below their target, they expect it to kind of get closer next year. Key thing, Fed funds projections. In March, they were pricing in one rate increase by the end of 2020. And now we can see that by the end of 2020, the Fed is really only penciling in a single rate cut. So why is the Fed so sanguine about growth in 2019 and 2020? Well, I think if you look at the nature of the economy, services comprise 85% of GDP, manufacturing is less than 15%. And in May, the ISM non-manufacturing index was 56.9%. Anything over 50 means expansion, and obviously the more above 50, the stronger the number. ISM May manufacturing was 52.1. So what we can see is that the slowdown that has occurred so far is truly concentrated in manufacturing. Go back in history. In 2008, both indices fell below 50. In 2016, manufacturing fell below 50, but non-manufacturing stayed above 50. So we can see there's quite a spread right now between the service economy and the concentration in weakness in manufacturing, which is primarily due to the trade information. Markets are way ahead of the Fed, in my opinion. Right now, they're pricing in almost a 96 probability of at least 2 cuts before the end of 2019 and almost 70% of 3 cuts. So why are investors so out of line with what the FOMC is projecting? The dot plot reflects each of the 17 FOMC members' rate forecast. It's updated quarterly, and it's their personal positions. It doesn't truly affect policy, but it's an important piece of information. In March, 11 members were looking for the Fed funds rate to remain unchanged, with 4 expecting 1 hike, 2 hikes. In June, that changed significantly. 8 members were looking for unchanged, only 1 member looking for 1 increase. And this is what the markets are really keying off of. 8 members now support cuts, with 7 of them looking for 2 cuts. So from the dot plots, people have assumed the Fed is going to move aggressively starting in July and follow through. But here's my take. There are 2 things, and this is what I've been consistent on over the last month or so, that will cause the Fed to act. First of all, they need data that shows the economy is slowing more than they expect. And that data, I don't think, is likely to develop prior to the July 31st meeting. One of the key points, I think, is whether or not President Trump levies more tariffs on China. The dots suggest the Fed's not going to wait if Trump moves to add more tariffs for the economy to show signs of slowing. They're going to assume it will slow, and they will act ahead of time. As Powell said in his press conference, an ounce of prevention is worth a pound of cure. And I think with the Fed funds rate as low as it is, the Fed may go with a 50 basis point cut instead of a 25 basis point cut if President Trump levies more tariffs. In the meantime, they're truly data dependent. Thanks for tuning in, and may good things happen for you today.